What's up, and welcome to today's video. In this video, I'm going to share how to turn your liability into asset. These are the important things property investors look out for. So it's very important for you to know how you could use your liabilities and convert that into assets to ensure you generate your cash flow instead of obviously becoming a liabilities. So again, if you like any of my videos, don't forget to hit the like button below, subscribe to my channels for more of these amazing videos. So there's so many people out there that really struggle to get into properties because they have lots of liabilities. What do I mean by lot of liabilities? Maybe they have very expensive cars that they pay for in a monthly basis. They've taken up a massive mortgage. They had a massive debt, wedding debt, basically, when they got married. Some of them had massive debt because of holidays they've been going to, using their credit cards, etc., trying to help people and forget to help themselves. So lots of people are really in this sticky situation. They really want to invest, but because of this sort of situation, they're really struggling to actually quit the rat race and invest in property full time. So basically, in this video, I'm going to really share with you how you can turn your liabilities into an asset, so it will generate you income instead of being a liability, instead of giving you sleepless night or basically getting you into so much stress and then end up making you depressed. So again, that's exactly what I'm going to share with you. But before we get to that, basically, we need to know what liabilities is. Liability is anything that doesn't generate you income, that causes you problem, right? I.e., it could be maybe buying a car or leasing a car, for example. You lease that car, whether you use the car or not, you have to pay your monthly lease. And then obviously you don't use the car often. Again, that becomes a liability. It could be a bad decision or bad debt you've taken that doesn't bring you income. And again, that becomes a liability as well. Or maybe in a relationship, right? You've got a relationship where you're the only one who's giving. The other partner is not giving back. So again, that partner becomes a liability because obviously it's not a win-win resolution, and obviously you're not getting a return on what you're putting in. Okay, so similar like that could be a liability. So what I want to do basically today is to show how you can turn that liability into an asset that will generate you income. Okay, that is the formula successful people do. That's the formula rich people execute to get them to the next level. So I'm going to share that with you so you don't have to worry about that, so you can easily turn your liabilities into an asset to generate your income. So let's get to it. We need to know first of all what return on investment is. Some people call it ROI. The R mean return, O mean on, and I mean investment. So your return on investment. Most people do not know what return on investment. They just invest or buy things. They don't even know if they're getting return on it or not. Right, most of them buy expensive things. They don't know whether it's add value to them, whether it get depreciated after they've bought it. So you need to know how much return you're making from actually investing, or basically in this terms, your liabilities obviously will not be giving you return on investment. So return on investment is basically what you get out from an investment you've made, right? It could be interest. It could be a return from investing in someone else, but things like that, that's what you need to know first before you even consider before you even start talking about liabilities, because liability is exactly the opposite. It's things that doesn't make you money, okay? So again, the formula of return on investment is basically, is your initial investment. You put all the initial investments, add them all up. It could be maybe the deposit you put in a house or in a business, and any expenses that goes with it. Basically you add all that up, and then you look at the net profit you make from that investment. Right, you look at the net profit you make in that investment. Obviously you add all the net profit, you get the total, and then you times that by 12. So basically your return on investment, it's your net profit divide by your initial investment. I'll repeat it again. It's your net profit or net cash flow if you're renting houses, divide by your initial investment. Your initial investment is anything you've put down yourself financially That's what your initial investment. It's not the loan the bank lend you. It's not the mortgage the bank lend you. It's the amount of physical cash you put into the business or into your property. That's what your initial investment is. If you've got the money from the bank, for example, if you got 75% of the asset from a bank loan, that is not your initial investment. Your initial investment would be the 25%. If it's the 25%, they've asked you to put down any administration cost and also legal fees, etc., etc. You would add up to give you your initial investment. So what you then do, you then look what your net profit is. Your net profit is all your income minus all your expenses. That's what gives you the net profit. And your net profit, some people call it net cash flow if you're doing property. You times that by 12, that gives you your annual net profit, and then you divide that by your initial investment. So let's look at it in a number form. Okay, we saw a property in the northwest of England. It's a 3-bedroom mid-terrace house, very suitable for a family, close to train stations, schools and universities, etc., etc., etc. It's a very, very good properties, and basically we're buying that property at 100,000. However, but it worth about say 120,000. But we're buying that property at £100,000. Okay, so what would happen if we're buying that property? We don't put all the 100,000 in to buy the property. Okay, so what we would do, we would approach a bank, and that bank will lend us 75% of the actual value of the property. Suppose, as we know, it's a £100,000 property, the bank will lend us £75,000, and that £75,000 would be your mortgage. Okay, and then the other thing also, we would have to put down 25%. Or up to 25%. In this example, we're going to say we put down 25%, right? 25% is our initial investment. Let's now assume we did the property up, we done it really, really nice, we literally refurnished it and then rent that property out to a family, right? We rent that property out to a family, and once we rent the property out, the tenant pays us rent every single month, and our net rent, which is our gross rental income less our interest, mortgage interest, would have paid for the 75,000 they've loaned us, our insurance cost, and our repair and maintenance, and any of our expenses that are included in that sort of property deal. And then that less all those amounts, that then gives us our net profit. So what we then do, we time that net profit by 12. Suppose that net profit is £2,500. Okay, so we have our investment, £100,000 property, right? The bank lends us 75%, which was the 75,000, and we put down 25,000. And our net profit was 2,500. So for us to know what our return on investment is, we would need to divide the 2,500 by 25,000, because the 25,000 is the actual money we put in the deal. That then gives us 10%, and that 10% is the return on our investment. Is the return on our investment. That is the return we get from actually investing the £25,000. In layman terms, this shows how hard our money has worked for us. So our money has worked for us 10 times more than what it would have done if we didn't use the money to do anything. So again, that's your return on investment. So then, how do we turn liabilities into assets? Suppose we bought a property in 2007, just before the recession. Property prices were significantly high by that time, so we bought it very, very expensive, and now property prices has gone down. So we would have been, if we bought that, because by then you were buying property at 100%. There was no mortgage. Then you can go, the bank would literally lend you all the money to buy that property. Let's say property prices goes up, then goes down slightly, and then that gets you to a negative equity. And negative equity is when the mortgage is more than the value of your property, right? That brings you into a negative equity, right? So some investors would struggle to keep that sort of property. One, they would have been in a higher interest rate, and secondly, they cannot sell the property thirdly, that property has become a rope in the neck because the tenant has been there for a very long time, and the rent is really, really less. So that property then becomes a rope on their neck, and they're not generating income from it. Probably even the rent the tenant is paying, they would have to top it up to actually be able to pay their mortgage. So then that property becomes a liability to them. So once it becomes a liability to them, what that means basically, they don't want to deal with that property anymore, right? But then as an investor, if you're in that position, you need to start thinking then, how can I use this negative equity property to be able to make it a cash flowing property, to make it an asset that will generate me income? We have few things we need to look into here. Number one thing we need to look for, are we able to sell this property at a higher price for some time in the future, i.e. find an investor who want to buy it as on a purchase lease option basis, right? We'll approach someone who wants to buy the property, say the property worth £100,000, and they will have someone who wants to do a purchase lease option that wants to buy the property for maybe 110,000 or maybe 115,000 in about 2 or 3 years time. So what that does basically, they would pay you your mortgage interest, right, that you pay, which you are struggling to pay in the first place. They will pay that on your behalf. And then we have something that we call option fees. They may also pay you option fees as well as a sweetener to keep you going. Again, that property then becomes an asset that will generate you income, right, after paying your mortgage and all your other expenses. You may be making £50 or £100 a month. Again, it's better than subsidizing that property. That's the first option you may be able to consider. The second option, you're going to look at the property, right, and see if you can add value to that property, right? Can we add an extra bedroom? Could we do a loft conversion? Can we have a conservatory at the back of the property? Can we extend the sideway? Can we, however way you can add value to that property, you look into that, add value so you can force the capital appreciation of the property. So once you force that, if the property worth 100,000, it will go up. Suppose the property was a 3-bedroom house, you convert that 3-bedroom house into 4 bedrooms, or by adding a conservatory or by adding a loft into the property, or basically extending it wherever you want to extend it, that then forces the property price to go up. What that then do, it increase the value of the property to maybe 150, 160,000. Alternatively, you could do the property and sell it for a higher price. And again, once you've added that value, what that does to your property also, it increases the rent. Because that property is no longer a 3-bedroom house. It may have been a 4-bedroom house with a conservatory or a loft conversion, whatever it is. You've added that value. So if the rent was £700, you would be getting about £9,000 or £1,000 for that property, because that property then has become a bigger property that would generate you much more money, that would give you a passive income. Again, these are one of the ways you need to look at the property to be able to make it an asset that generates you income. The second option you could do also, you look at the area, see if you can convert it into a HMO property, right? Instead of having it as 3-bedroom, you can look at it. If you've got 2 reception rooms, find out if you could do it as a 4-bed HMO. 3 bedrooms upstairs, one of the reception room into a bedroom, then you have 4 lettable rooms. And if you're renting it £400 each, you may be making about £1,800 or £1,600 a month. Okay, again, that's how you force the property to generate your cash flow. And again, if you change that property into a HMO, you eventually change the use. Guess what? The property price goes up as well, because then you get a commercial loan in that property, because obviously it becomes a commercial property because you're renting it room by room. Again, these are one of the ways you can literally force a property go up in value, because some of these properties bought them about 20 years ago, right? And there's so much potential now. The economy has grown. Council has been a bit flexible with this sort of property, so you can then go and add those values, and then that property then, instead of being a liability, would become an asset that will generate you income. Right? Recently, landlord approached me. He had a property, 3-bedroom, two reception room in a place called Tree Forest. Again, that property literally became a liability. He bought it in 2007. I literally told him to do exactly what I've just said here. We looked at the property. They're all three double rooms. They have 2 reception downstairs. I said, how about if you can convert one of the reception downstairs as a room so we can rent the whole property as a HMO instead of a buy-to-let family-let property. So again, we did that. He's making about £800 or £900 a month net profit in that property, whereas he was literally subsidizing the property because the tenant was only paying him about £450 to £500 a month, and his interest rate is skyrocket, and obviously he's got the expenses to pay and all that sort of thing. So we were able to transform that property from liability property to an asset that generates the landlord cash flow. These are the things you could do. And again, if you literally found a landlord who's struggling, you could buy these sort of properties, right? You can then buy that property. If you can think outside of the box, what you could do with that property, you can buy that property as an investor, and then guess what? You then do convert that property into HMO, and then you make money that way. And again, or you could convert the property into flat if you wanted to, into 2-bedroom flat, whether it's 1-bedroom flat or 2-bedroom flat, convert it into 2 flat, and again you have 2 cash flowing assets. So if you've got 2 cash flowing property asset, you're making double the rent. Suppose you convert that into say 2-bedroom flat times 2, you charge about maybe £550 each flat, you own £1,100. Right? If it's a house, the tenant would be paying £700. So again, this is how you create asset in a way that it generates you good return on investment. The other thing you could do also, if you own your home, right, and you decide to say, you know what, now I know what I know, and I rather have an investment property, because your residential property, unfortunately, is a liability to you. So how does it become a liability? I know some people are thinking this is crazy, but your property, the home you buy is a liability, because the reason is it doesn't generate you income. Whether you live in that property or not, you still have to pay your mortgage for that property. If you're on holiday, you're at work, you still have to pay your mortgage for that property. So again, that property is kind of a liability to you. So what some people do, especially the people that lives in London, what they tend to do basically is to rent this property out and move out to a smaller house that has lower rent, and then obviously get cash flowing from their property, from their residential property, to be able to pay their current rented property and make about £200 or £300 out of that sort of arrangement. Again, you could literally change your residential property into a buy-to-let property or let-to-buy property. Again, I'm not a mortgage broker, but there's so many mortgage brokers out there that would help you do that. So what you could do, you could even ask for consent to let, for example. You know, you could say, listen, I don't live here anymore. I've moved out. I'm working in XYZ area. It's not convenient for me to travel to work anymore. I want to be close to work. The bank would give you a letter or an agreement that allow you to rent the property for maybe a couple of years or so. If you decide to come back to the property, fine, you can come back. But if you did decide to continue it, when it's about time to remortgage your property, then you can then switch it to let to buy. Okay, very easy way to do. And again, if you need help with this, let me know. Comment on the link below, or literally contact my office, ask for me. I may be able to sit with you for about 30 minutes or so, explain to you step by step how you could do this so that you can release that to move on to rent another house, then allow that property to become an asset instead of liability. Because if it's your home, you live there, and it would definitely be a liability. So that way, then we can transform it into an asset that generates you income. Okay. And the other thing also, we buy cars. We literally, some of us buy expensive cars or lease these cars at very, very expensive interest rate. And then that car or SUV becomes a liability to us. So how can we make a car that we either lease or own become an asset? Right? Because most of us got these cars, they're literally just a liability. We're literally working for the cars, basically. It's ridiculous. Buy this expensive because only for people to say, wow, he's got an expensive car. Doesn't add value to you. So how can we turn vehicles like that into a cash flowing asset? Right. The first way of doing it, the first easy way to do it is to sell it. Right? Sell the house, sell the car, buy yourself as a smaller car, and invest the remaining money in properties that generate you income, right? If the money is not enough to be able to buy a house, you can go and take a rent-to-rent property deal or a rent-to-service accommodation property deal, or you can structure a purchase lease option deal. Again, if you need help with any of those strategies, let me know. I may be able to help you with this. So again, you sell that expensive car that you've been paying ridiculous amount of money on, buy yourself a smaller car that takes you point A to point B. It's not a competition, it's not showing enough. As long as it does what you say, what it meant to do that for now. Do delay gratification. So whatever is left over, you invest, right? If it's enough to buy yourself 80,000 or 60,000 pounds home, congratulations, go on and do that. If it's not enough to buy you a house, what you do, you use that proceed to get yourself a rent-to-rent property. It could be rent to HMO, for example, get in a 4-bedroom house that you can convert into 5, and then obviously take that from the landlord and then obviously rent it out and make about maybe £400 to £500 net profit every month. Again, it's better than you paying for that car, okay? Or you could take a service accommodation property where you could rent that property as a mini type boutique hotel. You can chuck that property in Airbnb, and that property may be generating you a minimum of £800 to £1,000. Again, that's a cash flow. That is money you'll be making without even owning that property. Okay. The second thing you could do, basically, you can create a company if you have money to invest in property. So what you could do, you could create a company, a limited company, obviously, and then what you do, you lease the car to your company. You've already got the car, right? You have a business now. So what you now do, you lease the car to your business. Right? You lease the car to your business. So guess what now? The business pays for your car. Because what would happen? You'll be using the car for your business purposes anyways. Most people are doing that without even taking that advantage. Okay? So then that car also becomes an asset now, because now the car, basically you've leased it to your business and the business is paying you for using your car. And guess what? Guess who uses the car? You're using the car yourself. Right? You're using the car yourself. So basically you turn that liability into an asset. Again, ask an accountant who would advise you properly on how to do this, but you could do it. It's legally allowed for you to do it. Right? So what you could do, again, I'll repeat this, create a limited company, right? That to do with property business or whatever business that you're doing, right? And then, right, lease the car to the business, and then the business pays you a lease for actually using the car. Again, that car then becomes a car that generates you income. The third option you could do is look for people who wants to hire cars. Okay, look for people who wants to rent a car for a day or two. So lease and rent the cars to them, because in most times you're not going to use the car anyways. If you're working 7 days a week or maybe 5 days a week, you're not using it for 5 days. Why not rent it to someone else? Right? Rent it to someone else. Again, that property then becomes an asset. It starts generating you income. These are the little things you could do to actually take your business to the next level, or take your financial situation to the next level. Right? I'm going to repeat all these strategies again. You need to know what your ROI is. Understand what ROI is. Right? Negative equities, try to force appreciation, or go into purchase lease options where you'll be able to literally pass the property on and then someone else will look after it, right? And then obviously turn your residential property into a buy-to-let property. That way then you start making money from the property. The property becomes an asset instead of liability, right? And again, you can use your car, as I've just explained, right? Creating a business, leasing your car back to the business, and then obviously you use the car. Or you could actually sell the car if it doesn't add any value to you, and you use the proceeds to actually invest in property, either buying property or leasing properties, so that you would make passive income in those properties. I really hope this video has been helpful. If this video has been helpful, don't forget to hit the like button below, subscribe to my YouTube channel for more of these amazing videos. Thank you so much for listening. I look forward to sharing the next video.